Okay, so there we go. So for this week then, we're beginning week 3. I can't even believe it. We're going to talk about long-lived assets or property, plant, and equipment, PPE. Don't get it confused with the other PPE that they're talking about these days in the medical field. But it's property, plant, and equipment, and it's normally a long-term, really established physical and intangible assets. So these are things like, the buildings, the equipment, the machinery, the systems networks. The intangibles could be something like, patents, copyrights, goodwill if we purchase it, and anything else that we can't really touch, but we know it's there, it's an asset, because without it, we would not be able to do what we are doing in terms of business activities. So that's where we're heading this afternoon. And so what I'm going to do is I'm going to give you sort of a broad kind of overview with it, because what I wanted to do was not get into the nitty gritty, even though the slides show you that, but I think it's really important to understand why it is that way. And what I think I'd like you to sort of take away from this chapter is if management has decided to amortize their assets or depreciate them in a certain way, why is it that way? Why would it be that way? And understanding why it's that way will help us understand what's happening on not only the balance sheet, but also on the income statement, because it does impact both statements. And so we have to be really aware of that, especially if we're talking to, creditors, because they'll certainly be interested in the depreciation expense. If it's quite a large one. So what I wanted to do was I wanted to begin with an example, of course, before I go into the slides. And I'm going to share my screen with you. And this is a company, I'm trying to keep local, a company in just near Vancouver, actually. It's called Rubicon Organics Incorporated. It is a publicly traded company, and it's fairly new. It's about 4 or 5 years old. And they are a licensed cannabis producer. It says here exactly where they are and what they do. And we can also look in the notes. This is just their annual report, quarter 4 financial statements. So I didn't get the annual report because we didn't really need it. So what I wanted to do was show you the balance sheet. And the balance sheet, they're doing pretty good, actually. They're growing quite well. What I wanted to show you specifically was the non-current area of the financial statements on the balance sheet. So this non-current, this might look familiar to you because we talked about this part of the balance sheet when we talked about cash flow statements. And the cash flow statement had a section on there called investing activities. Now, for me, as a creditor or an investor or a potential shareholder, what I'm interested in is cash flow. And so I'm looking at the cash flow statement and I want to know, how is cash used or provided to purchase or acquire long-lived assets or non-current assets, property, plant, and equipment, as you see here. So I want to know where the cash went to do that. How do we buy assets, and did we sell any assets and repurchase? Or do we liquidate our assets entirely? So I'm looking for that information on the cash flow statement. And this is where that investing activity statement or investing activity section relates to, is this right here. So if I can see the cash flow part, great. What I really want to know is, what kind of assets does this company have? Because these assets will help generate future revenue, not just this year, but future revenue. And if you remember, the very first thing I said on day 1 was, when we look at financial statements, what we really, really want to determine is, how likely is this company able to generate future cash flow? That's what I'm looking for, because this is past information. This 2019 is already telling me this already happened almost a year ago. So can I get information from this? Can I extract financial information that identifies whether or not this company is capable of producing future cash flow? Well, so far so good on the balance sheet here. But I know that they have property, plant, equipment, 19 million, et cetera. They own a big building, an intangible asset, an investment, and a right of use asset. So, well, they don't have the investment anymore, but they do have assets. So do these assets help generate future cash flow? So the key thing is they're not current assets, they're long-term. So if I purchase a piece of equipment, I can't expense it this year because I actually have this asset for a really long time. So it's capable of producing revenue every single year until the end of its useful life, whatever that may be. So what I need to do is recognize the portion of that asset that can actually be used to generate revenue for the current year. So all I'm doing is I'm prorating the value and I'm matching it with the revenue generating process every year. So if I buy an asset for $1 million and it's a 10-year useful life, according to the manufacturer, then I will be able to depreciate $100,000 per year. So that means that I'm recognizing 1/10 of that asset's use to generate revenue this current year. Next year, it'll be another 1/10. Next year, it'll be another 1/10. So I'm slowly just matching the use of the asset to the revenue generating period. That's all depreciation is. That's all we're trying to do. The way we do it changes. So by looking at this non-current section of the balance sheet, we can't actually tell what kind of assets they really are. So let's dig a little deeper. You'll see that there are notes here, notes 10, 11, and 12. So let's go find out what they say. So I do know the page number, but I just want to show you something first. Here we are at the cash flow statement, investing activities. So this is how the cash was used right here or provided. I deposit received on assets held for sale, and we purchased property, plant, and equipment. So cash came in and out, but for the most part, it netted out as cash used in investing. So that's good. I really want to see companies investing in assets to produce future cash flow. That's a good sign. So in the notes, another good way to understand what kind of assets this company should have and give us a sense of, the time frame, like how long should they own these assets for? Then what we really want to do is we want to say, okay, well, what does this company actually do? And that will give me a better perspective, or how big is this company? So Rubicon Organics, again, was just talking about this change in organization. They reorged it. It was a smaller company and then amalgamated with another one. There was a reverse takeover. That's not a negative thing. It's just the way things work. Basically just trying to consolidate a few companies. So they give you the background here. It's registered in Vancouver. It's a Canadian company. Their company's principal business is the production and sale of cannabis in Canada. Of course, cannabis became legal 2 years ago. And this is a very popular endeavor for many farming communities or agriculture. And they sell cannabis directly from its wholly owned, federally licensed 125,000 square foot facility in Delta. So that's what they do. Okay, so I have a pretty good idea. It's agriculture, it's greenhouses, it's all that goes into that. And they also have a sales as well. So it's not only just the farming part, it's also the distribution. So, and of course, heavily regulated. And so they talk about it a little bit more. So we know the history of the company. So what I'm going to do is I'm just going to go to the page where it gives us the information about the assets. So now it's giving me quite a bit more information. And this information will be helpful to me because now I see the bigger picture. Now I know what kind of assets they have. It doesn't tell me that on the financial statements because there's no room. So the notes expand on this. So when I start to put this into place, I'm like, okay, now they've got this buildings, leasehold improvements. They added some, there's an impairment, which means there's a devaluation or no more use. Maybe it was just decommissioned somehow. We don't know until we read the notes. There's equipment and vehicles. There's land, which we don't depreciate. There's construction in progress. So that means that they're adding on or there's another facility being built. So at least we have the sense of, wow, they seem like they're doing well. They're responding to growth and they have a really diverse portfolio of long-term assets. Now, they gave us a couple of notes. They also told us here that there's some accumulated depreciation, because one thing you'll know is that on the financial statements, some companies will, some don't. It's actually net book value is what you're seeing. So you'll see the total cost of the asset less this accumulated depreciation. And what this accumulated depreciation is kind of like a holding tank. So it basically is accumulating all the depreciation you've taken over the years. So if we have the $1 million machine and we've depreciated 2 years worth of that machine, we'll have $200,000 in accumulated depreciation. So what that's telling me is I've depreciated 2 years, which means I've got $200,000 in there. I must have $800,000 remaining because I know the cost was $1 million and it's over 10 years. So as an investor or creditor, I'm like, well, you've got lots of use of this asset. You've got lots of time left. But if it was reversed and we had $800,000 of accumulated depreciation, we know we're getting to the end of the useful life of that asset. So I would think to myself that, well, you know, they have a couple of years left. There might be the need for cash disbursement to buy a new asset. Okay, so you're getting closer to that time frame. So it gives us a sense of where the company's at with their assets. And so what they're doing here is they're saying, you know, here's the accumulated depreciation at December 31st last year. They depreciate the asset, they have some foreign exchange, et cetera, and transferred to assets held for resale. They're kind of giving us the mix of what happened during the year. But the interesting thing here is this net book value. So they're telling us the difference between last year and this year. And that makes sense because, you know, they've added some assets and reduced them. So it's going to fluctuate a little bit. But what this book value is, or what it's not, book value is not fair market value. It is not. All it is it represents the total cost of the asset, whatever you paid for it at the very beginning, as soon as you acquired it, and less the amount of the depreciation you've taken already. So the net value of these assets is really telling the users, this is how much you have left to depreciate. That's it. So we can kind of guess, okay, how close are they getting before they have to buy a new one? So we just kind of slowly bring it down, but we never touch the original cost. That's why we have this accumulated depreciation account, because we can, it's sort of like a holding account, like we did for sales returns. We just can't touch sales because we need it to be there. But we use it as a measurement, and depreciation does that as well. This depreciation expense and accumulated depreciation gives us a sense of how much we've amortized already, rather than chipping away at the cost of the asset. And it also gives us a perspective of, okay, we know the asset cost $1 million 10 years ago. What's it going to cost now? So maybe the cash flow expectations will have to be a little bit higher. The book value becomes a little bit more important later on as we talk about, well, what do we do with it when the asset's sold? So there's some rules of thumb, and they're quite simple. They also talk about intangible assets. So they have a Health Canada license application. And so in 2017, they acquired all the outstanding common shares of Vintages from related parties. So they exchanged some shares. It was a takeover. And then they just decide, you know, basically why they do that is because these other small companies are holding licenses. So if you buy the other company, you also buy their license. So they're amalgamating the value and the size of the license. Gives them the capacity to produce. So it's quite a common thing that happens in fishing industries, farming, quotas that come with boats and farms. If you sell a farm, you're also selling the quota that goes with it because it's able to produce that. So this is just giving us a sense of this intangible asset. It's a license. It's there, and without it, this company cannot produce cannabis. Okay, so it's an intangible asset. So it's giving us the background to that. So it's quite an interesting company actually, and they're doing quite well. Seems like they're holding steady, and there's lots of growth by what I've seen so far. So this is kind of setting the stage for the discussion on depreciable assets, but I want to show you a real set of financial statements, and these ones are really nice statements. I really like these ones. If you want to go look at their annual report, it's the Management Discussion and Analysis, MD&A, that's listed there as well. And it kind of gives you the background of what the company's doing. And it's basically from management's point of view. But these are the accounting numbers that we're more interested in. But this is sort of the general way, very standardized way of how we would present property, plant, and equipment. The details are in the notes to the statements. All right. Any questions about their statements? I really like their statements. They're really nice. Let's see here. Let's get on to the slides. Let's see if I can find them here for you. We are here. All right. Of course, I haven't set them yet. Let's do that now. So, as I said earlier, really just trying to understand what depreciation is as matching principle in accounting. And we're going to look at the three most common methods that are used. And again, there's no hard, fast rule that you have to use a certain method. It's up to management. They are the ones that decide. And then we introduce accumulated depreciation today, and we have a look at what happens when we sell assets and what does that book value really mean anyways. Okay, so I showed you what assets are. This is sort of just, a really generalized way of describing them. They have to be owned by the company. They have to be used to earn income from business. They're not inventory, so you're not going to resell them as that. And we're looking for more longer term use of these assets. Okay, and as we saw from that Rubicon example, you can see that, buildings, licenses, etc., are part of that definition. So I don't know if you recognize these buildings here, but that's the new UCW campus coming soon, right in there and right here. It looks pretty flashy. It'll be really exciting to get in there one day. This darn COVID would ever go. Yeah, it's kind of exciting. But these are just examples of what kinds of assets you might find in terms of financial statements that are more than 1 year, have more than 1 year's life from the balance sheet date. So total cost, the historical cost of these assets. So, it's not just the price tag of the asset that we have to include in the accounting records. It is historical, yes. We record what we pay for it, but it's not always just what we pay for the asset. Sometimes what happens is when we get the asset to our site, we actually have to make some adjustments to it. Maybe there's, some labor that's involved, or maybe there are some other setups that need to be done, maybe some different configurations, etc. So there could be. So basically, it's the cost of the actual physical asset, but it's also the other costs that are attached to it that get it ready for use. Okay, so all the costs up to that point that it's ready to go. That is the total cost of the asset. Okay, not just the price tag to get it there, but everything else. So shipping, insurance, taxes, if there's no GST type system where you get some of the money back. You'd also look at additional labor or setup, or, maybe maybe you have to move it from one location to another. Maybe you need to modify it in some way to get it ready to use. So again, it's just a matter of just keeping track of what costs are attached to this asset that's being set up in the books. So that's where it would be. Whatever the total cost of that asset is the historical cost of that asset. And so how do we measure the cost? Well, basically whatever you paid for it. But some people say, well, I didn't actually pay all in cash for it. What if you exchange shares and cash? That's quite common. I mean, there's lots of people are paid in shares sometimes, and it's still remuneration. It's still wages. It's just in a different form. It's not cash. It's just another asset. So it's still the same thing. Whatever the fair value is for that asset, whatever you gave up or received is the value of that asset. So nothing really changes. Just whatever you receive changes, but the value is still the same. What about land? Well, yeah, we do set land up on the balance sheet. It's a very big asset. You know, same thing goes, depends on what the cost of the land is and any other taxes or attorney's fees, any other costs that's associated with getting land onto that balance sheet and ready for use. The difference though with land is that we don't depreciate it. Land doesn't depreciate. It's set separate. We saw that example in the Rubicon notes. It's sitting there, it just is not depreciated. So again, same thing, it's still an asset. We attach all the costs to it, okay, to get it ready for use. So no different there. And so in this example here, what we see is basically, you know, the cash price of the property for the land, the removal cost of the warehouse, you know, maybe we didn't need it there. I mean, maybe the land location was amazing, but we just didn't need that old building on it. So let's remove it. And that's a cost because we're getting the land ready to use, okay? And the other standard fees of attorneys and commissions for the real estate broker. So the cost of the land was 100, but in actuality, it was $115,000. Okay. There's probably some government fees as well. I know in BC we have a property purchase tax. So that's also something you need to add in there as well. Any land improvements, driveway, sprinklers, maybe some landscaping, fencing, that sort of thing, depending on the type of land that you have and what you're doing with it. Most land may have a building on it, some don't. But again, in order to really utilize the land in a business, there has to be some revenue generating process in it. So pretty much the same for that. Buildings, same idea, whatever it takes to build it. In the Rubicon example, we saw that they had a facility that was in process, it was under construction. So all costs directly related to the construction of those buildings or the building is included as the total cost, historical cost of that. So if it's an existing building and we're renovating, remodeling, improving, whatever, that's added to the cost of that asset. Okay. So again, just trying to think of different ways we could attach costs to these long-term assets. Equipment, I'm not going to go over it again since I already did, but again, just going over the types of costs that can attach itself to equipment. And then of course, the good old example of what that might look like. This is quite common, people getting their vehicles ready or fleet of vehicles. TELUS is a good example. You know, you see any municipality, they'll have the labeling. Some companies would actually just wrap their entire car in their logo. So whatever the cost of that is really attached to that asset. This is going back to, was it chapter 2 or 3? Geez, I can't remember now. Anyways, in the first part of the course, where we have this balance sheet, this equation, this accounting equation, where we have the assets equal liabilities plus shareholders' equity. And so really what we're doing is just kind of revisiting that a little bit and trying to balance out what these look like. So if we purchase a truck and it costs $22,000 in cash, in addition to that, they had sales taxes, painting and lettering, license fee, and a 3-year insurance policy. So the way they're going to record these is we have to think about, okay, what do I have and how did I get it? What's changing? This is an economic transaction. So what changed? How did it impact the financial statements? What happened there? And so if we think about it this way, we had cash going out the door, right? We had $22,000 cash for the actual truck and also sales taxes of $1,320, painting and lettering and motor vehicle license. Now, the other one was this prepaid. So this is insurance. This hasn't actually been used yet because I bought it today and I bought the truck today. So I haven't used any of the insurance yet. So I've just prepaid for a $1,600 3-year accident insurance policy. So I have to recognize the use of this asset every time. That 1/36 of the payment will be recognized every month because I'm using that 1 month of insurance. It's sort of this adjusting entry that we have, and it doesn't impact cash. So in all, I had this new equipment. So all I'm doing is I'm moving the shelves around, right? I'm replacing the equipment replacing the cash with equipment. And that's what we want to see. We want to see things move like that because you know, I like to, you know, if I have excess cash, I want to buy an asset with it, even though it's depreciable. But it's easier to generate revenue with an asset than it is with cash. It doesn't quite work that way. So the more assets we have to generate revenue, the more success we may have in doing that. So anyway, so I see this balance between the asset and the rest here. All right, the license, of course, motor vehicle license fee, $80. That's an expense for the current year. It reduces income because it's an expense. So we have cash flow going down by $25,500 in total. Again, just trying to think about where's the cash going and what's replacing it, and what do I have? What do I have, and how did I get it? Repairs. This is always a really good question. I get this in tax quite a bit because it makes a huge difference for tax purposes. And what you have to think about is this an everyday repair patch, or does this, you know, become a huge part of this asset? Or does it change the expected useful life of this asset? And so let's take a roof, for example. There's a storm, you know, a tree falls in the corner of a building, we have to get the roof repaired there. That's a repair. It's not repairing the entire roof of the building, it's a section of the building. And so, oh well, it's an operating expense. We can't have it like this. It's going to rain and everything's going to get wet inside. So fine, it's an ordinary repair. If the tree had landed across the building and took out most of the roof, then yes, you'd probably have to repair the entire roof or the side of the building, etc. So materiality plays a big part in this. And if we can say that, you know, if we replace an entire roof, that does extend the useful life of that asset. Most roofs are about, well, unless they're metal, they're about 30 years for a shingled roof on average. I don't know if they last that long, but it depends how wet it is, I suppose. But if I have to replace all that and it's going to cost me $30,000, then I think that's pretty material. And it does extend the useful life of my roof, hence my building. So we have to make this judgment call. And you can see where management's like, well, if I expense it this year, I reduce income, therefore reduce taxes. But if I know I'm applying for a loan soon, I want to boost out my revenue. I don't want to reduce it. I want net profit to be as large as it possibly can to show the bank that we're capable of doing this. So I'll capitalize it instead. So management can really play this game. They'll gamify the financial statements, but they have to determine and justify why they decide it's a repair or it's an addition or improvement, like a long-term improvement. So management has to make sure they have all their ducks in a row and all their facts straight before they decide. So in terms of depreciation, again, like I said earlier, it's just recognizing a portion of the asset to generate revenue. That's basically what we're doing. So with the exception of land, which is also identified here. Now, if we have to think about why would management choose one over the other, there are three methods that we use. It's completely different than the tax system, but for accounting, we'll just focus on that for today. So again, we have this new truck, all the costs go into it, we set it up in the books, we decide based on our use, expected kilometers maybe, and the manufacturer's suggestion, it's going to last us a certain life, okay, before it becomes too inefficient to use or too costly to repair. And then the salvage value is basically what can we get for this truck when we sell it? At the end of its useful life, what is it worth? Now, think about what that is, because if we're going to get our cash back for this asset, it is an estimate, but regardless, if we know we're getting some cash back, we can't depreciate that value. We just can't, because we're getting it back. So it's kind of out of the picture. So what we want to do is establish what part of this asset do I depreciate? So that's a really important first step. So when we look at these three methods, we think about, okay, I can choose one of three. And it's not a good idea to flip back and forth. Actually, it's not allowed. When you pick a method, you got to stick with it. If for some compelling reason, management decides this isn't working anymore, then you can change it, but you have to substantiate why you've done that, because the users are looking at your statements going, whoa, this isn't comparable. I can't compare this. They're two different methods. Management has to disclose why they decided to do that. And moving forward, they can't switch back. So if it's compelling enough, it means they're probably not going back to the old way. So here we are with this new method. But for the most part, this is where we're at. The majority of the time, we're using straight line method. It's a quick and easy, cost less the salvage value divided by the number of years it's useful, and you get your annual rate of depreciation. The declining balance method, or the accelerated method, is looking at doubling up the amortization or depreciation, because you'll find that these types of assets don't have a long useful life and they become somewhat obsolete very quickly. So technology would be a good example of that. Some photocopiers are like that. They're like, yeah, 2 years and you're done, you need a new one. Or printers, those sorts of things, depending on how big they are. But you can accelerate. So you get a lot of your depreciation up front and it tapers off to nothing near the end, because that's where it's getting the most use, right? We're mapping this out with the most use to generate revenue. And then the last one is units of activity. So this is a unit of measure. So it's liters, it's kilometers, hours, very common for machinery. So it's based on number of hours used, or annual versus the total hours for the life of the asset. So again, it depends. Management comes up with this decision. It's not carved in stone. The financial accounting standards do not tell us which one to use. They just say, here are 3. You decide which one you would like to use. And it does impact your statements quite a bit differently. So as an example here, looking at, this is on page 266 of your textbook. So they have an example where the cost was $13,000 for this truck. The estimated salvage value is about $1,000. So all you're allowed to amortize is $12,000, because you're getting this $1,000 back. So you can't amortize it. It's going to last about 5 years, and estimated useful life in miles is 100,000 miles. Should be using kilometers. So let's calculate the straight line method, units of activity, and declining balance, just to give you a sense of how different they would look. So if we looked at the straight line, what we're saying is this 13,000 less the salvage gives us the 12 net. That's all we are allowed to depreciate. It's useful for 5 years. Depreciation expense is $2,400 per year. That's it. It's the same every year. $2,400 for 5 years. That's it. Nice and easy. If we want to make a schedule, we just keep doing that. We'll make some sort of amortization schedule for all of our loans, asset depreciation. We'll just have one file. We slide it away somewhere on a main drive or a G drive if that's something your company uses. And there it is. So we do end up with that $1,000 at the end. Okay. It should work that way. But we're taking 20% of it a year to match it to the revenue generating process of 5 years. That's the easy one. The other thing you have to think about too is, what if I buy the asset halfway through a year or sometime during the fiscal year? Well, we don't have it for the full year, but we do have it at some point in the year. So all you're doing is prorating it, and that's all they've done here. This is the only difference from what you just saw. So we're just recognizing, 9/12 of it here, and we'll see it on the end part with the 3 months left, okay, up to 12,000. So again, it's just a matter of recognizing how many months or days that you've had the asset for that year. Okay, so we just need to prorate it.
Anna home? Why didn't you come and see me?
Nope, hello. Microphone's on. So declining balance method is one of these where we want to accelerate the amortization depreciation, because the asset is just of no use to us after year 3, and we will be buying a new one. And so we're doubling it up. So it's double the straight line method. So sometimes you don't even have to do this on paper. You can just double. If you just did one, we could double it up every year. So you're taking the majority of the value of the asset up front, and you'll just look at the rest of it as time goes on. So if we look at the 13,000, this is a bit different. We don't actually take the net value. We're just saying here, 13,000 straight off the top. But what you'll realize at the end of this is we actually don't take that $1,000. We have to stop there because that's what cash we're getting at the end of its useful life. So instead of 20% a year, which is 1/5, we're taking 2/5 a year. Okay, so we're doubling up. Okay, we're grabbing what we can. And so annually, it's going to look a little bit different. So we've gone from 2,400 to 5,200, which is quite substantial, but we need to because of the type of asset. So at the end of the year, we have accumulated depreciation. The book value now is quite a bit lower. And this goes on and on and on. We multiply that times 40%, we get our annual expense and we accumulate it. So we carry on until we get to the very, see how it goes down every single year, right? Well, that's what happens. So what we have here though is we sort of have this, one more, go this way here. We only have a book value of $1,685. All we can deduct is $685 in the last year because that $1,000 is the cash we'll get for this asset. So we can't actually depreciate. So we just depreciate up to the salvage value, okay, for declining balance method. But we're just accelerating it. But you can see the difference. You know, first year is 5,200, second year 3,120, and then it tapers off. So management has to decide if that's something that applies to them or not, depending on the type of asset. And, oh, looks like I'm stalled here. It's frozen. There we go. Okay, partial year. So again, the same thing. We're just looking at when do we buy this asset? Sometime this is April 1st during the year, and I just prorate it. So I just keep going through the amortization schedule, and I have to plug this number at the end because I know I can't exceed that $1,000. I have to keep that $1,000 residual value at the end. Now, the units of activity method are quite a bit different. Well, what we have to do at the beginning of the year is basically say, this is how many units of measure I will have for the life of this asset. So I will need to get that from the manufacturer. I'm an accountant, I'm not an expert in machinery, so I need that information from somebody. So I will get an idea of, okay, if I want to use this for 5 years, how many hours do you think I'll be able to tack onto this machine? And they'll say, oh, well, 100,000 miles or 100,000 hours, that's all you're going to get. And then you'll need to reinvest in a new one. Okay, based on an average operating activity. So I know that I have this value, this $12,000 net value of this asset, and I know how many miles it will give me before I need to buy a new one. So all I'm doing is just spreading out the cost of the asset for the 100,000 miles. So 12 cents per mile is what I'll end up with. So every year I'm going to drive a different amount of miles. So all I do is take my 12 cents per mile and multiply it by the number of miles driven in the year. And lo and behold, there's your depreciation expense for the year. So this will change every year. It's not like straight line where it's the same amount every year or accelerated amount where it doubles up every year. This is more of every year it's going to be a little bit different, but I'm still going to track these miles, okay, the 15,000 miles. So I'm still going to have that, okay? So once I get to the 100,000, I'll know I'm at the end. So it's a different way because it just like with a building, this wouldn't make much sense because it doesn't have hours or any unit of measure, right? You're looking at machinery, equipment, systems, networks, vehicles, you name it. Okay, that's probably what kind of assets you'd see here for units of activity. All right, so far so good. Okay, so here what we have is just, again, showing you, it's still 12 cents per kilometer. It's still going along until it reaches that final number of 1,000. We still have the same rate per year. The miles driven are different. We end up with a different annual expense. And then we just make sure that we keep tacking them on so we know we get to the total that we started with. And there we go, right to the $1,000. So we know it's 5 years. So we know we're not going past that. It's just up to management what method they want to use. But what we have to think about is the impact on the financial statements and what that really looks like. Okay, so this 1,800 annual expense is on the income statement. It reduces income. The accumulated depreciation is on the balance sheet. So this book value you see here that starts to accumulate year after year after year, you're taking your total cost of the $12,000, and all of a sudden your book value is 11,200, and then it's 7,600, et cetera, et cetera. So we want to see the book value for depreciable assets decline. It should happen that way. Okay. And then we need to know what to do with it. So here's the difference between the three of them. And what you'll see here is these are, as a total of 5 years, this would be your total expense. So $12,000, $12,000, $12,000, it doesn't matter. You're still, no matter what method you use, going to use the same amount of the cost. The difference is what happens every year. Okay. You know, how does that look on the income statement? Your income is going to be a lot higher in year 2021 if you use declining balance method than it would with any other. So, but it suits the asset. That's just the way it is. Maybe buy a new one. All right, so far so good. Awesome. Okay, impairments. This is something where, you know, when we buy the asset, it's something that we don't normally think about, but it's more of a reflection of this decline in the fair market value of this asset. It's a permanent decline. So what we have to do is we have to write down the asset, the value of the asset. We don't want to overstate the books, the accounting records, because people are using them to make really good decisions. And if we overinflate the value of our assets, we could be in a little bit of trouble if we knowingly did that. Because if I make a decision on those statements, or the bank was going to lend me money based on this valuation of assets that have not been impaired for value anyways, and they decide to lend us money, and we can't make our payments, and like, well, I guess you know, sell your assets, and they can't realize the value we said we could on our financial statements, then we're going to be in a little bit of trouble. So they made a decision to lend us money based on what we told them. So we have to write the asset down to its fair value in the year that it occurs. So just so I wanted to throw that in there as well. Now, we don't keep assets forever. We dispose of them because we need to replenish, we need to renew. Depreciable assets wear out, okay? So there's a couple of things that we can do. Well, we just get rid of the asset altogether and we liquidate it. Or we sell it and buy a new one. Or we just keep it on site and just don't depreciate it anymore. I mean, we can still do that. But what we do is if we still have these assets in use, we depreciate them up to the point in time that we actually sell them. Okay, so because we're still using them to generate income. So what do we do? Well, think about conceptually what's happening. And this is where book value becomes a really important piece of the financial statements. I have an asset in my financial statements and I'm selling it. That means then I don't have the asset anymore. So I have to get it off my books. Now, I also have to take everything that goes with it off the books, like my accumulated depreciation account. Because remember, I couldn't attack the historical cost. I had to set up the accumulated amortization / depreciation because I can't touch the historical cost. So those two come off the balance sheet. But what else do I get? Well, I'm getting cash probably. I'm getting an asset because I just sold an asset. But we have to think about the missing piece. My equation won't balance, I don't think. Well, it might, but in most cases it won't. So we have to think about what happens when we depreciate, or when we sell an asset, what happens to those depreciation accounts. So a rule of thumb, book value. Let's start with the easy part. If I sell an asset that is equal to book value, let's use this example. Cost of the asset was 100, accumulated depreciation is 50. I now have a book value of 50,000. Okay, nice and easy. Book value is 50,000. I sell it for 50,000. Great, I take it off my books and I'm left with 50,000. So in comes the cash of 50 and off goes the books at 50. Okay, off it goes. So there's no gain or loss on this sale. Think of the asset. It is a depreciating asset, which means then I probably shouldn't get more than book value for it. I really shouldn't. I should be getting book value because I have been depreciating it. But it's possible that it goes one way or the other. So if I sell this book valued asset for $70,000, well, hold on a minute. I have a depreciable asset that should be worth 50, and I sold it for 70. Okay. Well, I sell my asset, so I remove it from the books with the accumulated depreciation. I get the $70,000 in cash, but there's a difference between the 70 and the 50, and that is a gain on sale. That increases your income statement, period. Okay, not too worried about the journal entries. Just know any asset that is sold for more than book value, the difference between book value and fair value, whatever they paid for it, is your gain on sale. And it does increase your income statement. Okay, it's not a cash gain. You got the cash, $70,000. The gain is recognizing the difference between book value and fair value received. That's it. Okay. If we take the $50,000 book value and I sell it for $30,000, that kind of makes more sense. It's a depreciable asset. I'm probably going to sell it for less, but anything that's sold below book value is considered a loss. The $20,000 difference between the 30 and the 50 is considered a loss on sale. Okay, so it reduces my income statement. It's an expense, it's a loss. It's not really cash loss, it's just a recognition of the loss. So why is that? Well, let's go back to the gain. I'm depreciating an asset and then I want to sell it, and I sold it for more than my book value. So what that's really saying is I probably took too much depreciation in the past, which reduced my income. And now they want it back. They're like, whoa, you took too much because you got more than book value for your assets. So that indicates that you probably got more than you should have in the past as a deduction. So we're just going to add it all back. Tax does the same thing. If it's a loss, it kind of makes sense too, because my book value is 50 and I know I paid 100 for it, but I never got to depreciate it all before I sold it, or what I thought I was going to. So the $20,000 difference between the 30 and the 50 recognizes that. So in doing so, they're saying, well, the standards are saying, well, you might as well deduct it then because you never got to. So we're kind of getting either an additional deduction or an additional increase in income because we either took too much or not enough. So book value for book value, no change. Anything above book value is a gain on sale, increases the income statement. Anything below book value reduces the income statement with a loss on sale. Okay, does that make sense? Any questions about that? That's why book value is very important. If you go back to the Rubicon statements, to the notes, you'll see that they had book value on there, and that's why it's important. Okay.
Can I just ask a quick question on the depreciation?
Sure. Mm-hmm.
So what happens on the depreciation then if you sold it for more? Do you then decrease your depreciation for that year, or you have extra?
No, you'll probably keep it the same. So what you're doing is you take your depreciation, say it's straight line, and we reduce the income statement because we're using it up to that point that we sell it. So that won't change. But what happens is we'll take whatever difference that is. If we took too much, the gain will be bigger. So we'll just add it back to income. Or if the loss is larger, we just reduce the income with the difference. So we have to keep the same system up to the point of sale, and then the gain or loss will take care of that in the end for us.
And it's just reflected on the income statement. It's not reflected at all by adjusting the depreciation.
Right, yeah.
Okay.
Yeah, just by the gain or loss on sale. You're right. Good question. Yeah, it's good to separate those two. Good. Any other questions?
Hello.
Hi.
Yeah, I was gonna ask, right? What if we have to revalue the asset? Let's say the value of the asset goes like from 50 to 100,000. What now happens? How do we apply the depreciation going forward?
Yeah, so if you do it at the beginning of the year, which would be the most ideal, then all we're doing is we're just revaluing the portion of the depreciation. So if they're, maybe you got a really good deal on the asset, they've had it revalued, maybe they had the assets appraised, and they say, well, actually this asset's worth 50,000 more. Then okay, then we actually add it to the value. We still will make a journal entry to increase the value of that asset revaluation. And say if we use a straight line method, then we'll just apply the straight line method forward. We won't actually go back to those past statements. We'll just do prospective, which is future only. So we have to disclose that change. And once we disclose the change in the financial statements, at least the users know why that depreciation increased, because, well, the value of the asset increased. But there has to be some documentation supporting that. And usually the appraisers report will show that, and we'll make the adjusting entries, and we just carry on with those methods.
Okay, and one more question, right? What kind of accounting entry do we do when we revalue asset? I know the asset goes up, then the other entry goes where?
Yeah, I guess it really depends on the type of asset, because you're right. I mean, you're not spending cash on it. You could actually throw it, well, retained earnings isn't the best place. You'd probably have to look at some sort of, you may just have to create a brand new line item or chart of account. Account would be something like, like an impairment gain or loss, or an impairment adjustment, or evaluation adjustment account. And you'd have to probably set one for each asset. So maybe each asset has one of those accounts, because you need something to balance it out in terms of, like an accumulated amortization. You can't touch the cost of the asset. You'll increase the value of it, but it's not really a purchase or cash transaction. So you need some sort of like cost adjustment or valuation account that you'd have to credit. Hope that helped. Good. Okay. Any other questions? All right. So just illustrating the transaction here, if we look at a July 1st transaction, they're going to sell some furniture for 16,000 cash. It originally cost 60. So that's good to know. It should depreciate. It had accumulated depreciation of 41,000. And then depreciation for the first 6 months of 2017 is 8,000. So they're going to record the depreciation expense as we see here. So equipment, we know, cost $60,000 originally, accumulated at 41 to start, and then we have the $8,000 for 6 months of the asset here. And so the depreciation expense is going to reduce the income statement. That's up to the sale of the asset. So no effect on cash flow yet. But we get some cash for it, $16,000. So the book value at the time I dispose of it, after the adjustments here, the 8,000 and the 41 are both tied together. I noticed that I'm getting 16,000, which is more than my book value. So what that means is I probably took too much depreciation in the past, because I'm getting more than what my value should be of a depreciating asset. So now I have this gain on sale of this asset. Okay, so which will increase your income statement. So these are really important to notice, because there's been lots of issues with public companies when they report their earnings. They have these gain on sales, and look at my income is so much higher than I thought, and they don't disclose, or they bury it some other way, and then it's realized that this is actually a short-term gain or a short-term loss, and all of a sudden the share price drops because they didn't disclose that up front. So management has to be really careful how they report these, and they have to better to fully disclose, because the market's going to figure out eventually anyways. So what if it increases your income statement or decreases it? It's a one-time only, and it doesn't repeat itself. Okay, it just happens in that year. So we have cash coming in of 16,000. We have equipment leaving the balance sheet of 60,000. The depreciation accumulated portion is also leaving, so we do the exact opposite. And then we have this gain on sale of 5,000, which increases the income statement. So that's where you'll see it. All right. So another way of looking at it, instead of selling the office furniture for 16, they sell it for 9. So this is the example of below book value. So we have this asset still book value of 11, and we sell it for probably a more realistic price. So now we have this loss on disposal. So basically I had 11,000 left to depreciate, and I never got to. So maybe I didn't take enough depreciation in the past. Well, now I'm going to get that $2,000 difference. I will get that in a deduction as a loss on sale. So same sort of thing here. We're getting cash of 9,000. Off goes the equipment, and off goes the accumulated depreciation off the balance sheet. And then I notice that I have a $2,000 reduction or an expense on my income statement. But again, it's a one-time thing. I'm not buying and selling these assets on an everyday basis. It's just an asset that happened to have been sold that year that was different than book value, and it won't happen every year. So users have to know that. Retirement of planned assets. So sometimes, like I said earlier, we don't always sell everything. We just kind of keep it kicking around, you know, like an old forklift or something. You know, it might be handy one day, so let's not sell it. Let's just, you know, leave it here as an asset. You know, it would still sit on there as some sort of, you know, relative value. There's probably always a salvage value that you could get for it, and that's probably where it's sitting at, because when you started your depreciation, you said I'd probably get $1,000 for it at the end. Then that's probably how it's sitting on your balance sheet. Okay. If it's not used to generate income or earnings, we just get rid of the accumulated depreciation for the full amount that we had the asset for its life, and get rid of the asset for the original cost of the asset. So we'll take it off there because there's no point having it there. We'll just have a fair value of that asset, which probably won't be much by then. One last thing, I'm not going to get too carried away with these ratios because we will see these in their entirety in chapter 9, which is the last chapter before your midterm. In terms of intangible assets as well, oh no, intangible assets will go here, but the ratios, something a little bit different. But we went over these. We talked about Rubicon having that license, the Health Canada license. It has value. Farmers have quotas, fishers have quotas. Anything that's licensable would have some asset attached to it. It has value attached to it. So without these intangibles, we probably wouldn't be able to operate. And a lot of them we don't depreciate because some of them never expire. Okay. Limited life intangibles, we amortize to expense. So if we have a patent that ends in a year, we are going to depreciate it for a year. If they're indefinite, we don't amortize. How can we when we don't know when they end? Okay. So there has to be a definite life for it to be depreciated. So we'll know how many years that we have it for. This just goes through the types of intangibles, some of the very common ones, the patents. It depends on some of the patents. I know a lot of pharmaceutical patents are very short-lived because you know, science and research happens so quickly that new things are always found. So they don't tend to have a very long shelf life, especially with lots of research and development. This just shows you what happens if they decide that they're going to buy the $60,000 patent. It does have a useful life. It's 8 years, so it has a definite life, so they can depreciate it. So what they're going to do here is they're just going to recognize the expense and the accumulation. There's no effect on cash. Copyright's kind of the same thing. Just kind of giving you a bit of background, around 70 years or so. It's a long time. That's a lifetime. And you can expense over the useful life if you can actually establish that there's a definite life. Okay? It might be hard. Trademarks, trade names, some of these have been around for a long time. So legal protection for indefinite number of 20-year renewal periods. So it just, again, it just depends what comes along with the trademark. But these are defended very carefully. So you can't get away with trying to copy some of these. They'll find you and they'll take you to court to stop doing what you're doing because it's infringing on their trademark. A lot of them around when you start looking. Franchises, same thing, you know, all the, you know, outlets. Starbucks actually isn't a franchise. It's Subway, Tim Hortons, you know, lots of fast food type places are basically your standard franchise. You buy the license or the franchise to, you know, be a Tim Hortons, and everything through that store is the same as it would be anywhere else. So again, it depends if it has a life, an ending life or not. And I showed you on the Rubicon Organics financial statements how it's presented. So this is just another snapshot from your textbook, but I always like the real life examples instead because, well, it's just something that's a little more current. Now, I said in chapter 9 that we'll be going over a lot of the ratios, and what each chapter is trying to do is show you how does this one apply to this material. And that's what this is here. So ROA, return on assets, is really just saying how useful are these assets? How well can they generate revenue with their assets? So what kind of return are we getting on these assets? And if we're really not generating return, then maybe we need to get rid of them or reinvest in something new, more efficient. So we take the net income and just divide it by the average total assets. So total assets mean current and long-term. And this just gives you an indication of the two airlines here. Averages for 5.7 for Southwest and 6.8 for this same year for JetBlue. So they're around the same at 1% difference almost. But of course, the JetBlue Airways is doing a little bit better in generating revenue with their assets. Again, these are also two, you know, we can't focus just on one ratio to get a really good understanding of what's happening in the company. We really need to look at all of them together to tell the story. But these are very specific types of very specific types of ratios to tell us how our assets are performing. So the turnover of assets, so how efficiently does a company use its assets to generate sales? Again, same sort of thing. The turnover rate for JetBlue was 0.77 times, whereas for Southwest it was 0.94 times. Okay, Southwest is a little faster at doing that. Not to say that it's bad. JetBlue has increased. It actually went up from last year, so that's good. 0.8 is the average in terms of industry, so not too far off the industry. We're getting there. JetBlue is getting there, but not quite. And profit margin. So again, we're just looking at return on assets. This is just showing you what the return on assets consists of. And if you take the profit margin times the asset turnover, that's exactly what you're getting. So rather than looking at asset turnover and profit margin, why not just look at return on assets? Because that's really telling you the same thing. Okay. So again, profit margin revisited. JetBlue and Southwest. Okay, so profit margin for JetBlue is slightly better than it is for Southwest Airlines, but you look at the asset turnover rates, okay, they're a little bit different. They flip-flopped here, and that's how we get our 6.8 and 5.7. So they're pretty darn close between the two of them. It's not really a huge deviation from one another. But overall, Southwest was just a little bit more effective at generating sales from its assets, and JetBlue is better at deriving profit from its sales. So again, just different utilization rates with their assets. Asset turnover. So this is just showing you again another example of how these ratios work. Really just looking at the relationship to sales and total assets, you know, what kind of performance we would look at over a period of time, not just this current year, but we need to look at other information. So this 0.84 asset turnover. It doesn't really tell us a lot. We would need more information. We would need something like, years, maybe 3 years back. So we have like 3 years worth of data that gives us an idea of where the company's going. And we might want to look at something in comparison to another company that's very similar to ours. But if we're just looking at our own performance, we want to make sure that, we have at least 3 years worth of data to get, at least establish some sort of pattern to see if we're doing well. So 0.84 might seem okay, but we actually don't really know until we have other comparative data. So this is just showing you the application. All right. Okay. So this was chapter 7. Chapter 8 is already recorded for you in the video. So I hope that's useful for you. If you do have questions, please let me know. I had to throw my fall picture in there. Although I did hear the robins out there today when I went for a quick walk. So it's kind of like spring, fall at the same time, which is kind of odd. Anyways, beautiful day. Hopefully we get to see a few more, but certainly doesn't make it easy to stay inside and do work like this. It's kind of the downside. Anyways, any questions? Oh yes, there was a question about the midterm. Yes, I have been thinking about what that looks like in terms of dates. And I don't actually know because the homework I'm trying to push as far as we can to fit all this really important information in. And so November 13th is the assignment deadlines. And so once that's done, then the exam would fall in after that. I try to place it for a weekend timeframe because it just seems people can accommodate their schedules better during the weekends rather than weekdays. And what it will look like is, it could be a number of ways. I think because we're online and we're dealing with a lot of us are in different time zones, which makes it difficult to actually write it all at the same time. So what I've done in the past is I've done like a release. So you have like a 24-hour period or a 3-hour period within a certain 48 hours or 24 hours. Basically what that looks like is as soon as you click on the exam, you have time, it's timed to finish it. So it's 3 hours, you have 3 hours from the time you access it. But within a 24-hour window is when people have time to access that exam. So it just makes it a little bit easier in terms of time zones. And also because it's a graduate course, I mean, it's looking at a little bit different, and that's the way I see it anyways. The graduate courses are more for, demonstrating your understanding with relevance. Yeah, keep up no exams. Yeah. I'm doing that in my tax class. It's someone saying, about don't do exams at all. And I'm starting to really think twice about how we actually learn. And what I'm doing with my tax class is for their final assessment is they're taking home a case. There are 2 cases, one that they do at the beginning of the term, and the final exam is fast forward 5 years, and they have to assess what happened and what the changes are and what their clients need to do. So it's demonstrating your learning and understanding rather than memorizing. So anyways, that's sort of the thought process that's going on. I know there's a lot of research to support that. I just don't have it at my fingertips. Yeah, and the stress levels for sure, but more marking. Anyways, yeah, so I don't have an exact date yet in terms of the midterm, but I will think about what that looks like this week and give you a more of a heads up. But you will access it within Moodle. So it will be there and it'll be timed. So timed in terms of when you can access it and for how long. I hope that helps. I know it's not a definite date, but I am working on it. Good. Okay. Well, that's all I had for this evening. I'll turn the recording off. Thanks everyone for joining.